The Toronto Stock Exchange Composite Index surged dramatically in 2025. This wasn't merely a cautious rebound or a holding pattern. It was a watershed moment that positioned Canadian equities for their strongest results since 2009 and among the most impressive performances in contemporary financial history. During this period, Trump issued tariff warnings, suspended trade discussions, and even floated the notion that Canada might lose its status as a sovereign nation. American financial experts forecast economic turmoil, mass capital exodus, and widespread investor alarm. Yet Canadian equities quietly generated returns that demolished U.S. market performance and exceeded even the most bullish forecasts. The S&P 500 achieved 14%, a respectable, steady outcome that American investors view as standard. The TSX delivered 32%, the type of annual return that challenges conventional wisdom about which markets provide superior gains and where sophisticated capital should flow. Trump anticipated fear. Instead, he witnessed one of Canadian market history's most powerful rallies. The sectors fueling this remarkable performance illuminate what occurs when a nation ceases awaiting American validation and begins constructing economic resilience independently. But before we explore this remarkable narrative, if you value comprehensive analysis of this caliber, please hit that like button and subscribe to remain informed on the developments that genuinely matter. Tonight, we're revealing which sectors propelled Canada's unprecedented gains, why American forecasts of economic devastation proved spectacularly incorrect, and what this performance signals about North American market dynamics going forward. The numbers that defy expectations. Let's begin with the fundamental data that contradicts every claim Trump and his allies made regarding Canada's economic trajectory. The S&P TSX Composite Index reached an all-time peak of 32,600 points in late December 2025, representing roughly a 32% annual increase. By mid-December, the Morningstar Canada Index had climbed over 29%, vastly exceeding the Morningstar U.S. Market Index's 15% gain. This isn't marginal outperformance or statistical variation. The TSX generated returns exceeding double those of American markets during a year when Trump implemented 25% duties on Canadian products, threatened USMCA dissolution, and repeatedly floated the 51st state concept. The outperformance becomes even more striking considering both markets' starting positions. U.S. equities entered 2025 at inflated valuations, with the S&P 500 commanding premium multiples fueled by tech stocks and AI enthusiasm. Canadian equities began the year underpriced and disregarded, with strategists questioning whether the TSX could match American market pace. By December, Canadian stocks traded at approximately 16.5 times earnings, above the decade-long average, but substantially cheaper than the S&P 500's 21.3 multiple. Canadian investors achieved superior returns from discounted assets. American investors secured modest returns from premium-priced assets. BMO strategist Brian Belsky noted in November that the TSX would surpass the S&P 500 by over 8% annually, marking one of the most robust outperformances since 1990. Only during 1993, 1999, and 2005 did the TSX generate double-digit gains while exceeding American markets by over 8%. This places 2025 among historically exceptional years, not merely strong for Canadian stocks, but among the finest in modern records. And this occurred while Trump actively worked to undermine Canadian economic sentiment. Broad-based strength across sectors. Canadian market dominance wasn't the result of a singular fortunate wager or one hot sector. It reflected widespread vigor across multiple industries, forming Canada's economic foundation. Gold mining led the charge. Companies like Kinross Gold and Agnico Eagle Mines posted gains of 19% and 14% respectively within just January 2025's opening month. Gold prices reached record highs throughout the year, driven by central bank accumulation, geopolitical volatility, and investors seeking refuge from policy turbulence. The irony is exquisite. Trump's trade conflict and geopolitical disruption pushed investors toward gold as a shelter. Canadian gold producers, dominating the TSX materials sector, captured enormous benefits. Trump's turmoil enriched precisely the Canadian enterprises he believed his threats would damage. The materials sector overall jumped 2.4% during a single December rally, showcasing continued momentum in mining and commodity stocks benefiting from elevated prices and global appetite. Financial sector delivered stunning results. The 6 major banks, constituting 32.5% of the TSX's financial sector, recorded extraordinary gains despite household debt and consumer concerns. Toronto DB Bank shares surged 60% annually, not 6%, but 60%. This happened while Trump proclaimed Canadian economic strategy was disastrous and implied Canada's banking system required American supervision. Canadian bank valuations reached levels unseen for over a decade, demonstrating investor faith in their profitability and stability. Energy sector profited from ascending oil and natural gas valuations, favorable governmental policies, and infrastructure developments like the Trans Mountain Pipeline expansion that enhanced pricing for Canadian producers. Clean economy investment incentives stimulated capital deployment into energy initiatives, establishing a beneficial policy landscape that compensated investors.
Tech stocks, led by Shopify, added to TSX gains, with the sector posting 2.5% increases during pivotal rallies in individual sessions. Though Canada's technology sector remains smaller than America's, companies like Shopify proved Canadian tech can compete internationally. Even the industrial sector, despite trade friction sensitivity, contributed to aggregate market appreciation as Canadian manufacturers navigated tariff uncertainty and preserved competitiveness. The pattern throughout these sectors is unmistakable. Canadian enterprises adapted to Trump's disruption, identified opportunities amid global turbulence, and generated returns justifying investor confidence. Why capital flight never materialized? Throughout 2025, American commentators and Trump administration figures forecast that businesses and capital would abandon Canada due to political volatility, tariff threats, and economic instability. The predictions suggested capital would migrate from Canada to the United States as investors pursued safer havens. Precisely the reverse occurred, and understanding why exposes fundamental miscalculations in Trump's team's assessment of Canadian economic fortitude. Valuation advantage. First, Canadian stocks entered the year markedly undervalued versus American equities. While the S&P 500 was priced for flawless execution with technology stocks at extreme multiples, the TSX presented value opportunities in resource sectors, financials, and energy companies trading below historical norms. When investors sought deployment opportunities in 2025, they discovered superior risk-adjusted returns in discounted Canadian stocks rather than expensive American equities. Multiple expansion, when valuations rise faster than earnings, drove substantial TSX returns as prices moved from suppressed levels toward normalized multiples. Perfect market composition. Second, Canadian market structure aligned ideally with 2025's macroeconomic conditions. The TSX's substantial weighting toward financials, materials, and energy positioned it to capitalize on trends disadvantaging American tech-concentrated indices. Gold's historic surge benefited Canadian miners far more than American markets. Petroleum and gas price appreciation rewarded Canadian energy firms. Bank of Canada rate reductions supported Canadian financial equities. These sector-specific advantages generated outperformance unrelated to Trump's tariffs and entirely connected to global commodity patterns and monetary frameworks.
Third, and potentially most significant, Canadian investors themselves ceased fleeing to American markets and began investing domestically. Desjardins strategist Tiago Figueiredo observed that Canada became a primary beneficiary of this transformation. Interestingly, domestic investors themselves appear to be rotating back into Canadian equities. This represents a profound psychological pivot. For years, Canadian investors presumed American markets delivered superior returns and allocated accordingly. 2025 shattered that premise. Canadian investors maintaining domestic positions in TSX stocks dramatically outperformed those pursuing American markets. The capital exodus Trump anticipated never occurred because investors, both domestic and international, recognized Canadian assets offered enhanced value and returns compared to costly American alternatives. Currency dynamics amplified returns. Canadian dollar weakness in 2025 provided an additional boost for TSX returns measured in US dollar terms. The loonie declined against the greenback as the Bank of Canada reduced interest rates more aggressively than the Federal Reserve, 275 basis points of cuts from peak rates versus more moderate American easing. For international investors holding Canadian stocks, currency depreciation meant returns amplified when converted to US dollars or other currencies. A 30% TSX gain in Canadian dollar terms became an even larger gain in US dollar terms for foreign capital. This currency effect enhanced Canadian stock attractiveness to international capital. Not only were underlying assets cheaper and delivering superior returns, but currency movements added supplementary gains for foreign investors. This represents the opposite of capital flight. This is capital attraction through superior risk-adjusted returns. The Bank of Canada's aggressive easing also bolstered Canadian asset prices by reducing borrowing costs and enhancing liquidity conditions. While some analysts worried rate cuts signaled economic weakness, markets interpreted them as supportive monetary policy justifying higher equity valuations. Governor Tiff Macklem indicated in late 2025 that the central bank likely finished easing unless economic data deteriorated significantly, creating expectations of stable monetary policy ahead and removing an uncertainty source. The business community's verdict. In early December 2025, the U.S. Trade Representative conducted public consultations regarding USMCA extension. Industry after industry testified that Canada represented a critical economic partner, and abandoning the trade agreement would devastate American business. Less discussed was what these industries said about Canadian economic performance. American companies with Canadian operations, supply chains incorporating Canadian inputs, and export relationships with Canadian customers weren't describing a failing economy approaching collapse. They described an integrated North American economy where Canadian strength bolsters American competitiveness. Canadian resources enable American manufacturing. Canadian consumer markets provide essential demand for American exports. Canadian financial stability supports cross-border commerce. The National Association of Manufacturers didn't testify about Canadian economic weakness requiring American intervention. They testified about maintaining robust economic connections with a stable, prosperous trading partner. This created a striking disconnect between Trump's political narrative about Canadian economic failure and American business testimony about Canadian economic importance. Trump claimed Canada needed America more than America needed Canada. American business leaders testified the relationship was deeply interdependent and severing it would damage American companies. Canadian stock market performance in 2025 furnished objective evidence supporting the business community perspective rather than Trump's political story. Markets aggregate information from millions of investors making actual capital allocation decisions. In those decisions in 2025, overwhelmingly preferred Canadian assets over American alternatives. Looking forward, 2026 outlook. As 2025 concludes and 2026 begins, Canadian market strategists express cautious optimism about sustained outperformance. RBC Wealth Management noted the S&P TSX continues trading at a premium to its long-term historical average valuation, but emphasized this premium remains significantly below the S&P 500's stretched multiples. The Canadian market enters 2026 with momentum, reasonable valuations, and sector exposures well-positioned for the global economic environment. Gold miners benefit from sustained central bank demand in geopolitical uncertainty. Banks have demonstrated resilience despite consumer challenges. Energy companies are positioned to capitalize on global supply constraints and supportive Canadian policy. The uncertainties for 2026 include the USMCA renegotiation scheduled for July, ongoing tariff ambiguity, and potential U.S. economic weakness if Trump's trade conflict escalates. However, Canadian markets demonstrated remarkable resilience to Trump's threats throughout 2025, with little reason to expect that resilience to vanish. Scotiabank strategist Hugo Ste-Marie stated in late 2025, "Although the TSX is not as inexpensive as previously, we believe valuation still has expansion room. We believe additional Bank of Canada and Federal Reserve easing will provide further support to valuation metrics." Purpose investment strategist Craig Basinger noted that if Canadian stocks' impressive run extends into 2026, the energy sector may need to assume a leadership position as gold miners face tougher comparisons and banks trade at elevated valuations. The fundamental point persists. Canadian markets entered 2026 from a strength position, with valuations remaining reasonable compared to American alternatives and sector exposures aligning well with global economic trends. The lesson Trump cannot accept. Trump cannot alter commodity prices through trade threats. He cannot modify central bank policies through trade negotiation tactics. He cannot compel investors to abandon Canadian assets, delivering superior returns to American alternatives. 2025 taught a lesson Trump either refuses to learn or cannot grasp. Markets prioritize returns, not political rhetoric. Investors allocate capital based on valuations, earnings expansion, sector positioning, and risk-adjusted expected returns. They don't flee assets because a foreign president threatens tariffs or suggests annexation. When Canadian stocks offered enhanced value versus American stocks, investors purchased Canadian stocks. When Canadian sectors aligned with global trends better than American sectors, investors favored Canadian exposure. When Canadian companies delivered earnings growth and rising dividends, investors rewarded them with higher valuations. Trump expected fear. He expected panic. He expected Canadian investors to desert domestic markets and seek shelter in American assets. He received precisely the opposite because his entire framework for comprehending market mechanics is flawed. Markets reward fundamentals over the long horizon. Canadian fundamentals in 2025 were robust. Commodity exposure benefited from global demand. Financial companies proved durable. Energy producers operated in a supportive policy environment. These fundamentals drove returns, making Canadian stocks the best-performing major market in the developed world. And here's the element that must frustrate Trump intensely. His threats likely made Canadian assets more appealing, not less. Geopolitical uncertainty drove investors into gold, benefiting Canadian miners. Trade war chaos created commodity supply concerns, boosting prices for Canadian resource exports. His aggressive approach towards allies increased demand for safe haven assets, strengthening Canadian financial sector performance. Trump attempted to demolish Canadian economic confidence and ended up contributing to one of Canadian market history's greatest bull runs. The final verdict. Donald Trump spent 2025 threatening Canada with economic annihilation, 25% tariffs, trade agreement termination, annexation rhetoric, constant assaults on Canadian sovereignty and economic policy. He anticipated market panic, capital flight, Canadian stocks cratering as investors fled to American safety. Instead, the Toronto Stock Exchange delivered a 32% gain, more than double the S&P 500's 14%, one of the finest years in modern Canadian market history. Gold miners soared on safe haven demand his chaos generated. Banks reached valuations unseen for over a decade. Energy companies benefited from infrastructure investments and favorable policy. Even Canadian technology stocks posted solid gains. While Trump threatened, Canadian companies delivered earnings. While he predicted collapse, Canadian sectors aligned with global trends. While he demanded submission, Canadian markets rewarded investors who recognized value over rhetoric. The record speaks for itself, 32%, and Trump's threats had nothing to do with it, except possibly making Canadian assets more attractive as refuges from his chaos. Markets care about returns. 2025 proved it.